if a company's doing really great, what the heck does it matter about the Fed? Why are you talking about the Fed so much, Jim? I sympathize with that view. Companies should be valued on their own merits. Same with strong sectors, as you will hear later in the show. But that's not always how it works. There are periods, extreme periods, where the economy gets so out of whack that the stock market itself becomes a pariah asset class, a source of funds for other asset classes. So an individual company's merits simply won't be reflected in its share price unless it catches a takeover bid. Given that the Justice Department and the FTC seem pretty hostile to mergers, I wouldn't hold your breath waiting for an acquisition to save you. So the bottom line, right now, we need to bow down to the Fed and the forces of inflation. Anything that brings down inflation, including tough statements from Jay Powell, will make big institutional money managers more likely to buy stocks rather than sell them.
Hello, everybody. I'm John. This is JP Strategic Investments. And today we're talking about Jim Cramer saying bow down to the Fed. And personally, I'm a guy that likes to think that stocks should be valued based on their own fundamentals, on their own merits. But in this case, he might have a point. And, some people love Jim Cramer, some people hate Jim Cramer. I think he's entertaining, I'll give him that. And whether or not you give merit to what he says, I think he's touching on kind of an important point here. And what he's really talking about here, what kind of he was saying, this is yesterday, he's talking about the market move yesterday. We got a lot of big upward movement, especially with some growth stocks. And he's kind of warning investors here, maybe you shouldn't be buying into these unprofitable, in particular, growth stocks. And he's saying we maybe have a little unwarranted optimism. And I think he's got a point. I think I've talked about this before, what it seems like right now in the current environment with interest rates, with inflation, what institutions are really caring about, especially with the algorithmic buying. One of the things on their checklist seems to be profitability. And that's why you've seen companies like Tesla and Apple and Google really outperforming a lot of the growth stocks that have been hit hard. Those stocks have still been hit, Tesla obviously down from its highs, Apple, Google. But as far as the broader sector of growth stocks, they've really done better than most, and it's really because they do have stronger profits and growing profits, more consistent profits than a lot of these other growth stocks, especially those that don't have profits at all. And so that is a point there that I think investors should consider. But the other thing that he's talking about, and I think this is really interesting as well, is yesterday we saw the Fed come out and say we're willing to get more aggressive on inflation, basically saying we're willing to maybe raise interest rates more aggressively and be more aggressive with, reducing their balance sheet and whatnot. And I thought this was interesting because generally rising interest rates are bad for the stock market in general. It kind of forces a shift from stocks into more fixed income assets like bonds and savings and things like that. But really what we saw here, especially what we saw yesterday, is giving us kind of an insight into how institutions are thinking. And right now it looks like institutions think that inflation is actually a bigger threat to stocks, especially growth stocks, than interest rates are. And so what we saw yesterday, the Fed saying we're going to be more aggressive and growth stocks rise, and all stocks rose, but growth stocks in particular, if you look at the NASDAQ, those stocks were rising. And inflation, just in case you guys aren't aware, the reason that it's a threat to stocks, and especially growth stocks in particular, is because with growth stocks, especially growth stocks with little to no profits, their valuation is based on their future earnings, right? People invest in growth stocks because they think they will make money in the future and make more money in the future. The problem is inflation devalues money over time. And if inflation persists longer and longer, higher and higher inflation, which is what we're kind of seeing right now, the future value of money is going to decrease significantly. And if you're basing the valuation of a company on future earnings, those future earnings are going to be devalued, which is going to force the valuation of the stock to come down. And so that's why we've seen a lot of these high growth stocks, especially ones with little to no profits, being hit pretty hard. And now we're kind of getting a peek behind the curtain, if you will, of what really institutions are looking for. And really, they're saying right now, inflation is really the bigger threat than interest rates to stocks in general and even to growth stocks. So it's always good to kind of get a feel for what institutions are really looking at, what they're valuing, because that can really help us kind of make predictions about what might happen in the market if certain things happen, because we know how the institutions will react. It's really important as an investor to understand what institutions are thinking, because it's going to help you make better predictions. So let me know in the comments below what you guys are thinking right now with interest rates and inflation. I'd love to hear what strategies you guys are using at the moment and kind of how you're managing your portfolio in the current environment. Other than that, I will see you guys next time, and have a great day.